Today, we're joined again by our friends in the VA loan world, Marcus Doe and Jonathan McIntosh.
Marcus and Jonathan are mortgage broker professionals who specialize in VA loans. They work with hundreds of veterans and transitioning service members every week through a SkillBridge program with Allegiant Vets, which is actually how I first connected with them. And they're licensed in 47 out of 50 states, so they've got a huge reach helping veterans across the country.
On this episode, we're diving into some advanced strategies with the VA loan. We'll talk about how veterans can use the VA loan to purchase multifamily properties, how the eligibility and entitlement calculations work, and how departing residents' income can help when qualifying for your next home.
So whether you're still in the military and getting ready for the transition, or you're already out and looking to build long-term wealth, this conversation will help you understand what's possible with your VA benefits. Let's get into it. Hello, everybody. It's me, Justin Woodall, here with Caleb Stewart, and this is another episode of the Navy Nuke Network Podcast, and we have another great episode for you talking about VA loans and a few ins and outs of how you can use that effectively as a Navy nuke in or outside of the Navy. Today, we have Jonathan McIntosh and Marcus Doe, and they're going to shed a lot of light on that subject. They're going to get us all on the same page about what to do with our VA loans.
Yep. So if you guys have been watching our podcast episodes, you guys have seen Jonathan before. He's talked to you guys about some VA loan benefits and things specifically nukes have to offer and some of the advantages that we have when it comes to loan opportunities. So Jonathan, for those of us who haven't watched that episode, if you kind of give us just a quick rundown about you and Marcus and how you guys met and your particular company that you guys are a part of.
Yeah, absolutely. Thanks for having both of us on here. I'm glad to have Marcus on here with me this time as well. So both of us are independent mortgage brokers, which means to you guys that we don't work for a single bank. We have access to, between the two of us, 150 or so lenders. Of those 150 lenders, usually only 16 or 20 of them are really good at VA loans at a particular time and have competitive pricing and good technology and process for you guys to get the loans funded quickly with the best price we can find. So the reason we chose to be on this side of the world versus working for a bank or credit union or whatever is because we don't work for the bank. We work for our clients, and we are constantly making our lender investors compete for our business, which is our clients' business too. Marcus and I have known each other for just shy of 20 years. I got him into the business just under 10 years ago. I've been in for almost 15 years. Both of us started our careers at Rocket Mortgage, which used to be Quicken Loans. So most people are familiar with that because they have a commercial, or they did, not as much anymore, but they did have a commercial like every 5 seconds for the last decade on every channel you could be on, golf, news, whatever. So both of us started there. I will still say that, that's probably the best training if any of you are ever interested in getting in the mortgage business. Probably the best place for you to start your career from a training aspect and really getting a lot of experience in a short span of time. So I got him into Rocket. Later on, he spent about 10 years there. I've been a broker for 8 years, and I've worked for a variety of different lenders before becoming a broker. And I kept getting beat by brokers, and eventually one day I just said, why am I not a broker if I keep getting beat by these guys? Like, why am I doing that? So long story short, in the last 18 months, we've become a part of a SkillBridge program that we do a VA presentation and assist military members that are exiting the military in that SkillBridge program. That's how Justin and I met, is through that SkillBridge. And so we have shifted our focus to heavily on VA because of that. And so our experience level in VA in the last 18 months has been even greater than it was previously, with the fact that probably half or more of our loans that we're working on now are actually VA. So we become experts, I would say, by default of being involved with that. Marcus, do you want to add anything to that?
No, I think you had covered a lot of that info. Obviously, I spent a long career at Quicken Loans, Rocket Mortgage, and during that time, I mean, it's a factory. You help a lot of folks, and I think that was one of the benefits that I had, and have been licensed across the United States from Hawaii to Maine. So I helped a lot of veterans in that time, but helped just a lot of people in a lot of different scenarios. So get that experience really translated well to helping veterans with their transition and relocating really from all over the world. So back to the United States during their transition period. So it's been a joy to help them, to get to know them and their families and their experiences, and then getting into their next chapters as they have been separating and retiring.
Yeah, Marcus, I appreciate you for saying that, man. For somebody that's a Navy Nuke veteran, just a military veteran in general, there's a lot of different questions that I've had going through the VA loan process. I bought a few houses and still don't know all the things I should. On the last episode with Jonathan, we discussed a lot of like basic stuff that I think that is very good for all of us to understand. And if I would have known, you know, 10, 15 years ago, back when I had the opportunity to start using these benefits, my life would be a lot different. And one of those ways that it could be different is by doing the things that we're going to talk about today, which we can just go ahead and start jumping into it. It's using the VA loan as like a real estate investment strategy and using it in multifamily properties. So, Jonathan, you want to lead us off and talk about how we can start
Yes,
doing that?
absolutely. So the VA loan is, I mean, in my opinion, the best possible loan you can get is buying residential property, and it can potentially be the best loan long term for obtaining rental property as well as your primary residence, because the guidelines are a little bit looser. The down payment is significantly less than it would be on FHA or conventional or any other type of loan product. So the big benefit is a lot of people are unaware of. You can, depending on how much entitlement you have left, which Marcus is going to get into with a little presentation to help visualize this. You can actually have more than one VA loan at a time, which a lot of people, even people who've had multiple VA loans, are not aware of, and they're also not aware of how to calculate how much more house you can buy with a second VA loan. The other thing, which there's been a little bit of guideline changes to this, is you can use a VA loan to buy up to a 4-unit property. So you can buy a single family home, duplex, triplex, or fourplex. And the big benefit on that is if you've been a landlord before, so if you've shown that you've been had rental history on a different property, we can actually use the market rent from those additional units to help you qualify for a much larger purchase price. So we've had clients that, would only qualify for a $500,000 loan on a single family, and they qualify for $1 million loan on a multifamily, which I think I touched on a little bit in the last episode about my largest VA transaction ever was a $1.5 million fourplex in Los Angeles. And so the guidelines did change on that a little bit. You used to not have to have a landlord history, and now you do. But if you are someone who's had a VA loan or any property that you've rented out, it doesn't have to be a VA loan property, then you can still use the market rents to qualify for much more. I think I'll let Marcus kind of get into entitlement, because it kind of starts with entitlement as far as using multiple VA loans.
Yeah.
And
If you,
you have a question, Caleb?
yeah, if you don't mind, for entitlement. So you mentioned the factoring in the rent, the prospective rent, as far as financing,
Mhm.
give you a bigger pool of money. Is there an effect as far as your interest rate that would be different by single family versus multifamily if you're going to
Yeah,
utilize the
that's a
VA
really
loan?
good question. That's a really good question. So, with every other type of loan, there is the pricing on multifamily is usually substantially worse. Like if you had a conventional or even an FHA loan, depending on down payment, then the rate is significantly worse. On VA, there is not an adjuster on that. So,
Hmm.
you're not getting penalized for buying a multifamily property. That's a great question that I didn't, that's something that we should talk about, because that's a big benefit that is only on VA.
I would also add to that is that yes, it can affect the interest rate a little bit, but it also changes how much on a conventional loan, if you're buying a 2-unit or a unit, you'd be required to put more money down than buying a single family home. So we're with the VA loan, potentially still not have to put any money down. Actually helping um, a veteran right now who just retired a month ago purchase a 2-unit property in Ohio. Very affordable. Doesn't have rental history, but we don't need that. Her goal is to buy a duplex, live in it for a year or two, and then as she starts to grow her family, get into a bigger home down the road, and then maintain and hold on to this property. The great thing right now is that she's going to live in one unit. Her mortgage payment is going to be around $2,300 a month. The other unit's already rented, and that lease is going to carry over with the purchase. And she's going to be collecting around $1,100 a month in rent. So really, the rental income that she's going to get is going to cover almost half of her mortgage payment, put her in a position to, decrease that monthly obligation to the mortgage, save some additional, money in the bank, and then eventually buy a new home down the road. She plans to buy a single family larger home for her family and then maintain and then have a duplex that's gonna continue to earn her money and grow in equity as time goes on.
Yeah, I think this is such a game changer for a military member simply because of the atmosphere of living on base and going through um, what we do in our training and when we as Navy nukes once we get to our ultimate duty station is there's plenty of opportunity for rental even just to your fellow military members, right? They all need a place to live. And Jonathan, you and I had talked about the last episode kind of even for a Navy nuke in Charleston that may be there for a little bit longer than normal because we're already going to be there for 18 to 24 months in the first place. But we talked about just strategizing once you are able to live out in town to pull the trigger and try to find something that you could either house hack or do what we're talking about, like get a multi family property so that you can rent it out to two, three, four, five, six other people because you could have 3 units, but 3 people live in all 3 units. It's a game changer, and there's plenty of opportunity for us to capitalize on that as another stream of income on our small military salaries when we first join.
Yeah.
Well,
Had
and I would
another.
say too. Oh, go ahead, Caleb. Good question.
No, yeah, just real quick,
Yeah.
specifically about the person that Marcus was talking about. You talked about that particular military member was planning on living in that particular duplex, I think it was, right?
Correct.
Yeah, for 1 year to 2 years. There's generally like a minimum requirement to where you have to live in the property, or does that vary based on like orders, or when it comes to specifically multifamily, is there any difference than in a single family?
Yeah, good question. So across the board, whether you're purchasing a single family home or a 2 unit property, the general intention, obviously, you have to live in it. Your intentions are to live in the home as your primary residence for at least a year. Now, it's flexible. Let's just say you're a active military member, you purchase a home, and then you get some new orders 6 to 8 months down the road. We just get some documentation to show, hey, your orders are moving you from Oklahoma to Oregon or wherever that might be, or California, then that's no problem. And we can look at purchasing a new primary home. And if you wanted to keep that home that you're in, great, you can rent it out, and then purchase that new primary. So generally speaking, yeah, your intentions are to be in the home as your primary for at least a year. But if there is some life event that comes up, whether your orders, you're getting transferred, or maybe you have a baby and you need a new home, a bigger home, something that comes up that is legitimate, then we can work through that with the lenders, and you can relocate and purchase that new home.
Yes, it's great. I know that's Jonathan talked about that specific scenario in a previous episode regarding single family homes. I just wanted to make sure that also applied to the multifamily properties. Obviously, if just as a real estate investor, right? If you're someone buying a property, and a factor in your math is to live in the property and then rent out the other end. Well, then based on military orders, if you move out, you got to also factor in, okay, now you need to get a new tenant in there. So doing that, that factoring in when it comes to that decision making, I would say important thing to think about, especially if, again, in the investment part of multifamily and something that you're considering. But yeah, that was all I
Yeah.
had. Jonathan, you had something you want to say?
Yeah, I was just going to say, Marcus's and I's experience with this skill bridge that we're working on. There's also a ton of veterans that are exiting the military, and they're in between military and getting a job, and there's a lot of them that need 90 days or 120 days of housing in the market they're moving to, in order to kind of bridge that gap. And a lot of them are moving in with their parents or in-laws, and they don't want to be there, and they're trying to get out as quick as possible because they don't want to be under the same roof as their mother-in-law. So I was just going to say, for those of you talking about or thinking about, buying, I don't know if this exists or not. There should be a military midterm rental, like Airbnb thing, where it's like, hey, you can, sign like a 4-month lease agreement, or, 3 months, then go month to month. Would be another avenue that, there's a big need for that. And we see that quite a bit, with the members that we're seeing exit the military. Is, they can't get a job typically till 60 to 90 days from their separation date, which means they're really down to the wire trying to exit the military, get a job, put an offer on a house. Like, there's a lot happening all at one time. So I would just say that, there's also that as a rental opportunity with the network you guys have. If you have houses available where you could do a midterm rental, is what we would consider that, that could be huge too, to keep it, occupied at a higher than long-term lease.
Yeah, that's great insight, man. I haven't thought of
Yeah.
it that way, but I would just, you're
Yeah.
firsthand, you see the need for it, so it's there.
Yeah, I mean, we never thought of it before either, really, until we just, started working with primarily people who are exiting the military right now. And then now Marcus and I see it all the time. Is there's people that are, in need of a 3 to 6 month place to get to where they're going to live, get their kids enrolled in school, figure out what neighborhood they want to live in, and then, not be in a rushed decision to buy a home because, they got to figure it out as they exit.
Now, Marcus, well, I guess we can go ahead and start going into the entitlement calculation, because that's what you need to go over next, right?
Yeah, we can
Yeah,
jump
just
into
because
that.
it'll kind of lead into, for those of you that are wanting to use your VA loan more than one time, it'll kind of make sense to go over how the entitlement calculation is factored, before we get into doing that.
Yeah, it definitely can be a mountain to climb to understand what entitlement means. So I'm glad that you're going
Yeah.
over this.
Yeah,
Yeah,
we'll
it's not
cover.
very straightforward, so we'll try and make
Yeah.
it as straightforward as we can.
Yeah, absolutely. You can definitely. I mean, I can. We've had a lot of conversations around this, and even when we think we've gone over it pretty thoroughly, we've still had veterans, not fully understand or just had a lot of questions. But we'll try to keep it, pretty simple. But we'll talk a little bit about just VA entitlement in general, just the basic definition and how that works, and then we'll give an example on how we can, if you currently own a home or plan to purchase a home, and then look to purchase a new home in the future, how we can do that and potentially do that without having to put any money down. So just kind of going over that now, just some of the basics. Obviously, entitlement, kind of the quick definition on that is the VA promises to the lender, if you default on the loan. So they're essentially covering a percentage of the loan, and they're backing it on your behalf. They actually particularly back 25% of the loan amount. So if you default on the loan, that's what they're covering. Full entitlement, which if you don't have any active VA loans, or never had a VA loan, no foreclosures with a VA loss, meaning if you owned a home and then you had a foreclosure, the loan didn't get paid off, then that entitlement is tied up and you lose that portion of it. But full entitlement means that you have no active VA loans and no foreclosures with the VA loss. At that particular point, there is no loan limit. So you can purchase $1 million home, $2 million home, as long as you have the income to qualify, and you won't have to put any money down whatsoever, which is a huge benefit. That actually changed a few years back at the end of 2019, 2020, when that actually came into play, where that, if you have full entitlement, there is no loan limit, and you can not have to put any money down whatsoever, which is awesome. If you have partial entitlement, meaning that if you have an active VA loan or you lost some entitlement due to a foreclosure, then bonus entitlement kicks in. With bonus entitlement, essentially, let's just say you have an active VA loan and then you're looking to purchase that second home. The VA will cover 25% of the loan amount up to the county loan limit. So every county is a little bit different in their county loan limits, and they'll cover up to that county loan limit without having to put any money down whatsoever. With that, so just once you hit that county loan limit, the veteran would be required to put 25% of every dollar down. And we'll go over an example of what that looks like. So let's just say you purchased a home in 2018. It was your first home, kind of a starter home. Maybe you were active duty at that particular time, where you were stationed, and you just bought a modest home or a home that worked for you at that particular time, and you purchased it for $250,000. Of course, you didn't have to put any money down. So let's say you didn't, and to keep things simple, you had a loan amount of $250,000 as well. If you then look to want to purchase a home today, family's growing, you've now looking to relocate or get into a bigger home. Obviously, home values are up a little bit higher today. If you're looking to, again, upgrade the home, get into something a little bit bigger. Let's say, for example, that you're looking to purchase a home in Denver, Colorado. You wouldn't have to put maintaining the current home that you have. So if you keep that home that you purchased in 2018 for $250,000, if you can go up to a new purchase price of $556,000 without having to put any money down whatsoever. Based on that, if you would then above and beyond $556,000, then you have to put down 25% of every dollar. So, for example, if you were to purchase a home for $650,000, you would have to put $23,375. So still really, even though you had to put some money down, still far less than what you would be required to put on a conventional loan, a minimum of 5%, right? So that allows you to still get into a VA loan and all the benefits of that, being able to utilize the VA IRRRL, interest rate reduction refinance loan in the future, and only have to put down $23,375 on that purchase price. Now, if you were to purchase a home, let's say in San Diego, California, homes values are a little higher there. So that county loan limit is a bit higher than Denver, Colorado. So, and if you were to purchase in San Diego, still maintaining that original home that you purchased, you could get up to $827,000 in a new purchase price and loan amount without having to put any money down. But let's just say that home purchase price was around $900,000. Then you'd only have to put $18,112 down. So,
yeah, so the biggest driver in these two scenarios is that county loan limit. So in these situations, it's not necessarily listed on there, but that's the cap there at the 556 for Denver and the 827 for San Diego. Is you can't get that is the loan limit for that particular county.
That particular scenario, yeah. So that's now if they purchased a $300,000 house originally versus a $250,000, then obviously that would change that scenario.
Yeah, it would.
So
yeah,
okay. Exactly. So that's just an example. If you were to that first home that you purchased for $250,000 and you maintained and held onto it, and you decided to rent that out, that's what this scenario would look like. Obviously, these numbers would change a little bit depending on what the original loan amount was on the first home that you purchased.
Comparing this to conventional, Marcus mentioned on the Denver, Colorado example, you'd have to put 5% down, which would be, over 30,000. So it still is going to be your best option versus doing a different loan product. In most cases, there could be a point where conventional starts making more sense, but we would run the numbers on that to figure that out. But certainly in the second scenario, putting 18,000 down on a $900,000 house, that will never happen on an FHA or conventional loan.
Right.
That's where that is a huge benefit, is an example number 2.
Yeah, great example. If you were to buy a house for $900,000 with a conventional loan at the minimum 5%, that's $45,000 that you'd have to put down versus only the $18,000 with the VA loan. So still a huge benefit.
That's really good. So just so I'm hearing this correctly, and I assume, right, the county limit, right, that maximum purchase price it pretty much is going to go up based on the cost of living in that area, right? You're going to, generally speaking, have a higher maximum purchase price in a more expensive place, and lower as far as that goes, as what would be expected.
Exactly. Yeah, that's where they recognize, like in San Diego, I think the county loan limit is a little bit over $1 million there. In LA County, it jumps up to a little over 1.2. Versus in Denver, it was a little over 800,000 for the county loan limit. So, it's all different for every county across, and a lot of them are the same, Like I was kind of looking at some examples. Some of this, there was actually some counties in Ohio that I was looking at that had the same county loan limit as Denver, Colorado. So
Wow.
it really comes into play, especially in places such as, San Diego and Los Angeles, where home values are, generally always higher. But yes, the county loan limit has significantly jumped over the last couple of years. Heck, during COVID, I mean, a lot of the county loan limits were in the 500,000 range. So this has jumped significantly, obviously with the cost of living going up, but it's really been a huge benefit, I think, if you've currently own a home, and especially if you bought it pre-COVID, where home values were still pretty affordable across the country, and then COVID happened, and we've seen it, just an increase in property values over the last several years. That really puts you in a good position to hang on to that home that you bought, in 2018 or 2019 pre-COVID, rent that out, continue to grow equity, get that residual income from the rents, and then purchase a new home today.
Yeah, and obviously growing your rental portfolio is an awesome way to grow wealth. But for some of us, say that's not necessarily something they want to do. Um, and another way to get to where you don't have to pay any down payment is to, I guess, refinance your current VA loan if you're in that portion to open up that entitlement as well, right? That's an option.
Yeah. You can restore back to 100% entitlement if you refied out of the VA loan. So a lot of people don't want to do that because they bought a house in, 21, 22, and they're at a 2.5% interest rate.
Yeah.
But yes, that is correct, is that if you did refi and got rid of that original VA loan, then you could go to San Diego, for instance, and now you have no limit again. And that's a huge deal. That's a very recent change, especially, a lot of guys probably in your network are on the higher end of income wise and moving to more expensive markets. So what is it? Was it 10% before, Marcus, or was it 25% when you hit jumbo VA before they got rid of that you had to put down when you hit a jumbo? You had to put a percentage. I think it was 10%. Like, it's been so
Yeah, I
long
think it
ago, I can't
was.
remember. Yeah,
And then
so
they got
5 or
rid of
6
that.
years ago, if it was an $800,000 county loan limit, then if you went to a million, you'd have to put down 10% on anything over that 800. So that first loan now not having a limit is really huge, especially for people who have not bought a house or not retaining another VA loan. Is there's no way to get into a $1 million+ house on any other product with no down payment. I mean, most of the time when you get into what we call a jumbo loan amount, you're putting 20 or 25% down, which is a quarter million or more dollars.
One thing that I would add into Justin's point, and what you mentioned, John, is if you're in a situation where we need to refinance out of that VA loan into a conventional loan to restore and go back to full entitlement, I would definitely, start trying to plan ahead. If you think, what, within the next, 6 months to a year, that you're going to start actively looking for a new home, and your current home that you own, you just know that you're probably going to need to refinance that because maybe you bought it within the last couple of years, but it's a home that you definitely want to keep as an investment. I would definitely urge you to get in contact with a loan officer, mortgage broker, start talking about that ahead of time, because then if we can refinance that out of a VA loan into a conventional loan, we do that soon enough, then we can treat it as a primary residence, which just puts you in a better position interest rate wise when we can treat it as a primary on a conventional loan. Versus if you were to try to do that simultaneously as you're purchasing a new home, then we have to treat it as a conventional loan. And then you get a little bit higher interest rate. Yeah, or an investment. Yeah, exactly. And then you end up getting a little bit higher interest rate. So doing that sooner, we can treat it as a primary. We can refinance out of the VA loan into a conventional, not have to bring any money to closing for that refinance, restore that full entitlement, and then allow you to go purchase, maybe your dream home with no money down,
Yeah,
and still maintain the rental.
I did have a situation in the Denver area last year, actually, with a gentleman that had a $200,000 mortgage on a house he bought 10 years ago, small house, and then he was retiring, got a really good job in Colorado Springs, and was buying a house for like 900. And we did concurrently refi that other house to free up his entitlement, and then because he didn't have the cash to buy the the more expensive house. He didn't want to have to put the money down. So we did do it concurrently. It did make his transaction a little bit more stressful, having to close 2 loans at once versus a single loan. So like to Marcus's point, if you are like, hey, in 6 months to a year, I'm probably going to want to upgrade to $1 million house. I don't want to have to put money down. I would get on the refinance process in advance, because it'll just make your transition smoother. And also, if you don't have a intention to move at the time you do that loan, then we don't have to treat it as an investment property at that time.
Yeah,
So
that's
if you take
awesome.
anything away from this, it's got to plan ahead.
Yeah,
absolutely.
If you can. I mean, life
Yeah.
happens and you never
Life
know.
happens.
But if you're like, hey, I'm having a kid, I know this house isn't going to work for me in 2 years from now. I know at some point in 2 to 3 years I'm going to move. If you can get ahead of that a little bit, it'll just be a little smoother, and might end up saving you a little bit of money doing it in advance.
I mean, like both of y'all had said earlier, we're talking, like our audience we're talking to right now, a lot of them might be in this situation because they're moving across the country or going to a new job, getting out of the military. So it's more common than I guess somebody might think that people would be in this situation. So to plan for this, in that transition time is also something that would be beneficial.
Yeah, so I just got a follow-up question. Obviously, we're kind of talking about, right, you're in a residence and then you're looking towards moving towards your next home. When it comes to qualifying, right, for that second home, what if you're someone who, okay, I know I'm leaving, but I want to utilize my old residence as an investment property? What avenues specifically can you go to when it comes to qualifying for the second home?
Yeah, we actually have kind of a breakdown of that to kind of do a visual example. If Marcus, you want to bring that back up while I get into it. So basically, if it's what we call departing residence income. So if you own a property that's your primary residence now, you're like, hey, I have, either enough entitlement that I don't have to put a down payment, or I'm okay with putting down whatever it ends up being, 20 grand, 10 grand, I have the cash. Okay, great. So we can use the rental income from your departing residence to help you qualify for more on your new residence. So here's kind of a breakdown of what that looks like. So if let's say that your house right now, you have a $3,000 mortgage, the rental income in your market is $3,500. We will give you credit for 75% of what the market rent is, which is determined by either by an appraiser or by a lease agreement. So if you get a lease agreement, and the underwriters do check, so if you put $10,000 a month on a house, then that's $500,000. Like, they're going to figure it out. But if it's within reason, they're not going to question it. And so you get a lease agreement for $3,500. 75% of $3,500 is $2,625. So that would result in a negative $875 rental income, which means essentially you have an $875 debt, like similar to a car payment or personal loan, but that's still better than having a negative $3,000 debt if we weren't using the rental income. And the rental income can only go up to what your current mortgage payment is. So you can't exceed $3,000 worth of credit. So for example, if your rental income was $4,500 and 75% of that exceeded $3,000, we're not going to give you credit for that. We're only going to give you credit up to your total mortgage payment.
Yeah, I'm sorry. You're not treating it as a business or another like portion of your actual W-2 income. This is just you have a investment property, but we don't want to necessarily penalize you if you're actually making money off of it. So it's that 75% of whatever you're making is just kind of a balance of giving you credit for having it, but not again treating it like it's a second job per se for the paperwork's sake.
It's vacancy factor is what they call it. So they're assuming that you might have 25% of the time where the house is vacant in between tenants, or you got to do renovations, whatever. So they give you 75% because they're accounting for potential vacancy.
Yeah, that was gonna be my question. I was wondering if there's any occupancy requirements, and that would, I guess that having a occupancy rate of 75%. Now, do you have to, if you have a lease agreement like you discussed earlier, if you have a lease agreement, do you have to, and say nobody's moved into it yet, do you have to have like proof of the deposit or anything, or is
Yes.
you do?
Yes, you do. Yeah, you do. So they've tightened up on that across the board with conventional VA and FHA. 5 or 6 years ago, I think on VA it's always been, Marcus, correct me if I'm wrong. Right, conventional, we didn't used to need a deposit. VA, I don't remember a time when we didn't need it. You do have to have a deposit check as well. So lease agreement and deposit check are required in order to use that income. So yeah, it would just be in addition to whatever your other income source is. So if you make $100,000 a year, we're going to say, okay, you make 8333 from your job, and then we're going to take away, in this scenario, 875 a month of that 8333, and that's going to be your net income. But if you didn't have the rental income, your net income would be 5333. So it will help you qualify for more. And another thing to add to that really quick before I forget is, if you move out of your house and you file a tax return, because you've been renting out your previous residence, we're going to have to go off of whatever that tax return says. And a lot of accountants are very good, and they'll make it look like you make no money or lose money. So it's great for taxes. It's bad for loans. So just keep that in mind. Yeah, keep that in mind. Marcus and I have seen that quite a bit, where it's like, oh yeah, I'm making $3,000 a month. It's like, well, your CPA says you're losing $2,000 a month.
Right.
So,
That's what I was going to do. He hit the nail on the head there. What I wanted to clarify is that this scenario is when you're departing your current primary, getting a new tenant, and then departing, and that's how we calculate that income, and then you move into that new home. That's how we can qualify, and then it essentially takes you from that $3,000 obligation. We're only obligating you to $875. But like John said, now a year or two from now, when you look to maybe buy another home or maybe look to refinance and we have to use qualifying income, we're going to now go off of what's reported on your tax returns, as John said. So always keep that in mind. Same with self-employment, same thing with rental income. The more you write off, the more losses you have. The bigger we hit you on your debt to income ratio for qualifying. Generally speaking, a lot of the times we don't see always positive rental income, but the tax returns, offset that payment obligation, sometimes show a little positive income, show a little bit of loss, depends on what, you write off, or what's on the tax return. But definitely, I wouldn't, if you can't avoid writing off extra, especially again, going back into that planning stage in the future, having a good conversation with us on how we can qualify for that new home before you do your taxes is a benefit.
And what all you just talked about is why they call it, this particular scenario, the departing residence income, right? The departing
Correct.
residence, that's the key word there, because you're departing from your primary, getting new renters and renting it out and all that kind of stuff. So, all right, cool.
Exactly.
So I would imagine in this whole scenario, one of the most important things you need to do is make sure you have proper documentation. Basically what you guys are saying in that scenario, just have all your I's dotted, T's crossed, make sure you have it, make sure you're working with somebody like Jonathan and Marcus so that everything's covered, so that you don't have to show such a big loss, and you can recoup and change your debt to income ratio to where you can be approved for more.
Yeah, kind of the unintentional theme of a lot of this conversation is becoming plan ahead.
Yeah.
Think ahead, plan ahead.
That was not the intention of the goals, but
yeah, but now I'm realizing, basically, as long as you plan ahead, think about what you're going to do, talk to one of us, before you take a huge loss on a rental property. If you're going to be buying something in the next couple of years, if you're like, hey, I'm not going to buy anything for 5 years, fire away, take as much write-off as you can, but just keep in mind, that is going to limit you on your next move if you don't think ahead a little bit.
I just now realized that after we've gone through this podcast up to this point, we haven't discussed or even brought up the fact that we're all wearing blue shirts.
Nobody talked to each other before either.
Didn't you get the memo, Justin? I sent it out before, so
blue shirt.
I didn't get it.
Blue shirt.
Yeah, I didn't get the memo.
Yeah, blue collar shirts, man. That's just the way to go. But I promise, we did not plan this whatsoever. But blue shirts or not, to everybody that's watching, Jonathan and Marcus are doing great things for the military community as a whole, and I really want to get them involved in the Navy Nuke community because they know so much, and they've had so much volume of people, like Jonathan talked about in this episode. And what we talked about in the previous episode is that I went through that SkillBridge program. There's hundreds of people in that SkillBridge program going through that they get access to and talk to and hear their scenarios. We're talking they're messing with dozens and dozens of people every time they get on and talk to those members of the Allegiant Vets SkillBridge. So they have really, really good knowledge on how to navigate transitioning military members and already transitioned. So don't think just because you've been out for 10 years you can't talk to them. But they're doing a great thing for our community. I want to help them because they're helping us. So in the description below of this video, we'll have a link so you can go make a one-on-one call with Marcus or Jonathan and talk about your scenario, figure out what's best for you, and maybe you can get to a point where you can either increase your rental portfolio or start trying to get these multifamily properties where you can take advantage of it and start building wealth while in the military, or just simply utilizing your benefits to do that now that you're out of the military.
Yeah, I 100% agree. And one of the things that I urge, and I actually have a good friend of mine who used to be a loan officer with me at Quicken Loans Rocket Mortgage, and he has a daughter that's been serving for 6 years in the Air Force, and she was stationed in Oklahoma for, gosh, 3-4 years at least, and now is getting relocated to Missouri. And I said, asking my friend, I said, why are we not urging her to buy a home right now? She's been stationed there. She was renting an apartment. And, a lot of folks, a big question we get from a lot of, or comments that we get a lot from folks is, I just want to rent for a little while. I'm waiting for home values to come down or waiting for interest rates to come down. And, the interest rate on rental is 100%. You don't get any of that money back. I would say, a lot of the veterans that John and I are helping, we're getting folks into new homes for less money out of their pocket than they would have to getting into a new apartment, right? First month's rent, last month's rent, deposit. We're just actually helping a veteran in Michigan right now. He closes tomorrow. He's bringing to the closing table $683. And he had no deposit. So that's the only thing out of his mouth. Yeah, incredible. He's buying a $700,000 house and he's bringing less than $1,000 to the closing table. So that's where we just see a lot of folks that are just waiting. Maybe waiting to see where I'm going to relocate in the future, or waiting for something to come down in values or interest rates. And during that time, we're seeing just home values continue to go up month after month, year over year, and there's always ebbs and flows, but generally speaking, it's a great, home is a great investment. And even if you end up selling it 2-3 years down the road, you're going to walk away with some cash, some equity, or if you decide to turn it into a rental, it's a good way to go.
Yeah.
Well said, man. Well said.
It's amazing.
Don't buy that BMW and buy the house and let the house buy you a BMW in 10 years.
Yeah, exactly.
There you go. Yeah, just crazy. It's really cool story, Marcus. The VA loan just in general is such a powerful tool, and all the different aspects of it. We talked about utilizing for multifamily, single family, and then again talking about utilizing the different avenues, even strategizing to get your next home. Definitely hope our listeners have listened in to the first episode we had there with Jonathan, and even this episode, definitely utilize a VA loan when it comes to building future wealth for your family. We really appreciate you guys' time.
Absolutely.
Oh, of course.
Thank you guys.
In future episode, we have plans. We're going to talk about which Marcus had alluded to earlier, the interest rate refinance reduction loan, right? We'll talk about that the next time we get together. Stay tuned, and we'll see you in the next video.